Hi, this is James Shug with Westpac London's end of day report for Friday the 9th of November. Well, finally a bit of an up day after the worst or the biggest sell-off on US markets, at least weekly sell-off since June. The rising consumer sentiment that we saw in the preliminary November University of Michigan series was unexpected. Fourth rise in a row, took it to its highest level since mid-2007 with both expectations and the current component contributing. Lower gasoline prices probably a factor at play there. That news kind of offset, at least for the time being, ongoing concerns about the fiscal cliff, which is becoming increasingly in focus, I think, in investors' minds now that we've got basically the same political makeup after the US elections as we had before. The European data flow today included a steep fall in French industrial production, down almost 3% in September, which gives us more confidence in our view that Euroland GDP, which figures come out on the 15th of November, gives us more confidence that our minus 0.5% forecast is probably about right. It's actually at the bottom end of the market range. In the UK, as well as having a narrower trade deficit because of a rise in exports and a fall in imports, the bigger news was that the Bank of England has decided to transfer £35 billion worth of income that it's earned on its holdings of asset purchases, gilts, as part of its quantitative easing program, back to the Treasury. The Bank of England governor described this effectively as equivalent to an easing because the Treasury will pay down debt with the proceeds, and that effectively means there's £35 billion put back into the economy, and in exchange for taking assets out of the system. So which is effectively what QE does. It's interesting, that's just one step away, of course, from the Bank of England simply writing off its holdings of UK government bonds. You know, one arm of the government owes money to the other arm, why not just write the whole lot off? Well, there are arguments against that, which I won't go into now, but one collateral impact of that is that it's worth just over 2 percentage points of GDP, 35 billion, and that'll lower UK public debt by that amount, which will help the Chancellor achieve his targets in terms of debt reduction, or debt stabilisation, which at this stage he looks like he might miss, given that the economy has been struggling, except for the latest rise in quarterly GDP, and revenues are down. So that was the main UK story. I mentioned the French one. So that was really the data flow. Ongoing concerns about Greece. We've got EU finance ministers meeting on Monday. Lots of comments out of Europe from various officials saying it doesn't mean that Greece will default, even if we don't decide to give them the 31 billion tranche of bailout funds that they've been waiting for since June, but not really that convincing, those comments really. So that's why markets are up a bit. I mean, the 0.3% rise at 4:40 p.m. in London in the US market, in the Dow, is just a very modest gain after the steep losses of the last week or so. But nevertheless a rise. The Dow's at 12,854 at the moment. The FTSE's unchanged today. The French market up 0.5%. The German market down 0.5%. The Spanish market up 1/4, and the Italians off 0.1%. Commodity markets are mixed, with copper prices down 1% today. Oil is up 0.75% at $85.70 a barrel, and gold on $1,735 an ounce is up 0.5%. The Aussie dollar's drifted a little bit lower. It's at just under 1.04 against the US dollar. One late story worth mentioning, just coming in. The US banks apparently will not have to meet the latest Basel requirements for capital and liquidity provisions by the 1st of January 2013. Can't give you full details in that story, just a headline that's just flashed through, but that's probably worth watching for in a bit more detail over the weekend. All right, and that's it for the week from me. I'll be back next week.